Over the last month, the market has been all over the place, and the REIT sector is no exception. While many stocks have pushed higher, VICI has been on the wrong side of the momentum, sliding down more than 7%. And if we zoom out year to date, the broader market has performed well, yet once again we can see the REIT space does remain mixed, and if we look specifically at VICI Properties, well, they're down more than 4%. That isn't just it. If we take a look, they're also trading at a 52-week low, which does put the dividend at the 6.4% point. And interestingly, we're also seeing a double respectable buy rating from both Seeking Alpha and Wall Street that sits around the 4.3 out of 5. 4.5 would flip that into a strong buy rating. But here's where things get more serious. VICI currently holds a borderline safe dividend score of 50, which when we take a deeper look actually signals a moderate risk of a dividend cut over a full economic cycle. So in today's episode, we're going to cover three key things. The true safety of the dividend. We want to understand what have management revealed in their latest investor presentation, and my own valuation margin of safety to determine whether this is a buy at today's price or in fact a stock that we should be running from. Now, before we dive in, for anyone new to VICI, it is a triple net REIT that owns some of the most iconic gaming and entertainment real estate in the US. These include major Las Vegas Strip properties and leases them to long-term tenants under essentially inflation-protected contracts. We can see here these are just a few names, which I'm sure you've probably heard of quite a lot of them. And if you wanted to see a bit more of a breakdown, well, they have 13 tenants, in fact 93 properties. And what's interesting to note, their two largest by quite some distance are Caesars Entertainment as well as MGM Resorts. And one thing that we always like to just discuss, although it is quite some years away, is the WALT, which stands for the weighted average lease term. Now we can see here Caesars the largest, around 30 years, so still quite some way to go. And not only are they in fact the two with the largest number of properties, but if we do total the annualized cash rent, well, in fact, it's sitting at 74%. If you include the Venetian, it sits at the 84% level. So also important to understand the future of these companies, as it is something VICI Properties does rely very heavily on. And we can see the average, in fact, of these 30 tenants currently sitting at 40 years. Also worth highlighting, it's not just Vegas, there are also other geographical locations, some that you may have heard of, some that you haven't, but essentially showing there is quite a bit of diversification here. Also in that the different revenue streams, we have hotel rooms, gaming units, convention spaces, as well as a few others. And as we said, the top two do make quite a significant portion of their overall revenue, so it's great to see when the tenants continue to invest in the properties. It does give you faith that they are looking to stay there for the longer term, and that's probably for some people not even a question. That is a guarantee, but this does just help. We can see here the most recent one, Venetian Resort in Vegas, announcing a $1.5 billion reinvestment, and we can see here Caesars October 2024 with something similar around $435 million. Very important, as we said, it does make up a large portion of their top line revenue, and they have what they like to call 10 trophy assets on the Vegas Strip. Also, another thing worth noting, we can briefly touch upon it, is in terms of the traffic of Vegas, which from time to time we hear news it has started to slow down, but they have here what they call the Sports Triangle, driving southern Las Vegas Strip activations, as well as potential opportunities. In fact, they say they own the real estate of 6 casinos within and alongside the Sports Triangle, and they name here 3 different stadiums, where one in fact is also under construction, which will overall help boost the local economy and leading into more people coming into these properties. Now, we have to make you aware that just from a few weeks ago, a few analysts have downgraded their expectations on the company. We have Wells Fargo from just a few weeks ago. They've reduced their price target to $32 from $36. Still, as we've just seen from the share price, that does lead to some very nice upside, but their concerns here about the limited fee of their gaming opportunities, as well as some of the potential issues with VICI's Caesar regional lease. And we've highlighted here, it is quite significant for this in particular. It's 25% of their operating income, and something similar from just a few days ago where we saw Evercore ISI, the exact same concern they've lowered their price target pretty similar down to the 32 mark. And again, the concerns are on the exact same thing. So definitely something to think about. We can incorporate this into our valuation. And speaking of, when we take a look, now typically on the channel, when we're looking at companies, we look at the forward PE. However, for REITs in particular, we want to look at the PE to AFFO, the adjusted funds from operation, and it's trading at the lowest in the last 5 years, probably the lowest this company has been on if we had the data, 11.6, well below the average of 14.4. And whilst we don't look at this in isolation, we would say here potentially severely undervalued. In fact, the highest it has sat is the back end of 2022 at the 18 mark. And if we couple that with the yield at 6.4%, again, the highest this company has offered in their history, significantly higher than their 5-year average of 5.1. In fact, we do notice the lowest mid-2022 at 4%. These two do signal to us that VICI Properties at a high level could be in a severely undervalued level. And again, if we take a look at the blue tunnel, it confirms that exact same thing. Undervaluation, it is sitting below the bottom end, and for those that don't know, this highlights the fair value intrinsic price. We've only noticed potential undervaluation once or twice in the last 12 months around the beginning of the year, and always good to see the blue tunnel, whilst only minimally, and we would pretty much expect this for a company in terms of VICI's growth, it is trending upwards. And if we were to zoom out to the last 10 years, well, again, very obvious to note, this one over the longer term does move in the right direction we want to see, but has also offered investors sometimes here to buy this severely undervalued. Clearly, we noticed this. In fact, it was trading around $11 during that COVID drop. But other than that, we can only really notice one time where we saw a huge dip. So maybe gives us faith to, one, take a closer look, but two, also seriously consider this, especially if we want some REITs in our portfolio overall. And we also get a B+ on the valuation. Again, we don't take a look at the PE, but you can see it there if this is something you want to look at. We look at the price to adjusted funds from operation, 11.8. The sector overall sits at 15.2. So for VICI Properties today, we're looking at a 22% discount. But if you want to look at other metrics here, we can see for the most part, they are looking very strong for the company overall. And it's also worth highlighting the impacts that rate cuts could have on REIT industry and VICI Properties. It is looking likely, although from a few weeks ago it was up in the air, that we are going to see a likely rate cut in the December 18 meeting. And what this does, based on history, is that we can see REITs perform fairly well when rates do get cut. And one thesis you could have behind this is for those investors who currently have their money, whether it's in savings account or bonds, as those rates start to come down, they'll still want to get an attractive yield and move those funds into companies, REITs for example, where the yield does look very attractive. VICI Properties could be a contender for one of those. But also fascinating to see what the institutions are doing, because their ownership is very high, 98%, and actually they sold just under $5 billion worth of shares in the last year. However, they bought nearly 50% more at $6.9 billion, again in the same time frame. So whilst over the year it looks like they've been net buyers, if we take a closer look at Q3, the most recent period, well, we can actually see they flipped the script. They actually sold more than they did in fact buy, something that when we do zoom out and look at the last few years, we actually only notice this quarter, in fact Q3 of 2025, where institutions have actually sold more. Now, it doesn't mean we shouldn't consider buying or we should consider selling. It is just one layer of our overall investment thesis. And if we look at their growth rate, which also looks strong, 7.5% is the rate they've grown their adjusted funds from operation year on year over the last 3. That's above the sector at 4.6, and over the last 5 years, extending it further, looking even better at 8.8, again above the sector at 2.6, where over the next 12 months, they anticipate it to grow at 4.5, again looking better than the sector. The same conclusion when we do look at the year-on-year growth, telling us this company is trading at a discount of more than 20% to the sector, but actually their growth metrics pretty much across the board are looking very, very favorable, which is always a good sign, something you want to see, especially if you believe there is opportunity in the company that you're looking at. And profitability, also another very strong score at A+. Again, depends on which ones you want to look at, but if we take a look, for example, at their cash they generate from operations, 2.5 billion, significantly higher than the sector at 262 million, and we'll also touch upon their margins, but you can already see they are looking very strong with the A+ rating. And if we do take a look at their earnings, well, over the last 4 quarters, 2 of them and the most recent ones, they were in line or in fact did beat. So 50% record, not great, not the worst. Over the next 2 quarters, they're projecting double-digit growth to their funds from operation, with the subsequent 2 being negative. But overall, and this is what we want to see, is growth to the funds from operation, which in turn will lower, as we can see here, the forward P to FFO. Now let's cover their metrics and understand why we did in fact see there that dividend safety score at the 50 borderline level. First one that actually correlates to that metric is the adjusted funds from operation payout, where for other companies we look at the free cash flow payout. AFFO is more appropriate, and we can see here we want below 75% for this industry in particular. And what's interesting to see, it pretty much is at that level very consistently, expected a little bit lower at 74 over the next year. And that's very interesting because this is one thing that management do target, a 75% AFFO payout. So that looks good in terms of no worries so far for the overall dividend safety. And then the next thing is, unlike other companies, again, the free cash flow per share, we want consistent growth over the longer term. We want the exact same thing, but for the AFFO per share, and that is exactly what we get, consistent growth year on year, and it isn't expected to not continue over the next 12. So again, does look very impressive. AFFO, if you want to see that exact same thing, but the percentage change does look good. 5% last year, 4% on a trailing 12 month, a little bit lower projected over the next 3. But as we saw, based on the previous numbers, it is expected to close the year around the 4 to 5% level. And sales growth, if you do want to note, for REITs, we aim for 5 to 10%. We see there or thereabouts over the last full year, but this is a company that has historically seen some very large numbers. You should also be aware, with REITs in particular, they do dilute your position as a shareholder, so this isn't anything new, and they have consistently done this. Some REITs, in fact, do it much faster than others, and the main reason, as we can see here, is they do not hold a lot of that internally generated cash flow. Most of it does go to dividends, and that is why they need to do that share dilution. In terms of total sales, also looking very strong, although a bit of a slowdown, maybe something just to keep an eye on. And we can see the ROIC for typical companies, we want 10% or more. Give us faith that management are able to effectively allocate their capital. What we want for REITs is 3 to 5%, which is what we get. 6% very, very consistent in the last 2 years and on a trailing 12 month, so no worries here. In terms of the margins, looking very strong, around the 90% in terms of the operating side. And the last thing here is the net debt to EBITDA, which really does affect that overall dividend safety score. Now, we want below 3.5 for hotel REITs. For REITs in particular, we want to see less than 5. So just bear in mind that for hotel REITs, we do drop this down to 3.5. And if you don't know, the numbers below are the number of years it would take VICI Properties to pay off all of their debt net of cash on hand. Now, it has come down from the most recent peak in 2022 at 6.46, now sitting at 5.29. Good to see that slowly, steadily, it is reducing, projected 5.1 over the next year. But this is really the key driving factor for why we see the borderline safe dividend score. If in fact this continues to drop over the next few quarters, over the next few years, it is likely we will see that turn into a borderline to a safe score. Now, what we can do to really counteract this is that when we look at our margin of safety, we can add an additional layer, which we will consider. Now, bear in mind though, VICI Properties, what does give it a lot of strength, firstly, as a company overall, when we consider the barriers to entry, how easy is it for another company to come and copy what they're doing? Well, pretty obvious, it is very high. Whereas if you applied the same logic to other REITs, well, in fact, you could argue very low. And as we said, they have some very, very large names on the Vegas Strip, as well as others that we did pinpoint. The other thing to note is when we did see COVID, their rent collection was 100%. Now, you may think that is pretty obvious, but if we compare that to others during that period, it was sitting anywhere from 15 to 19, which is always great to see. Also phenomenal here, 100% occupancy. When we take a look at others, it sits at 99%, and even Realty Income, the monthly dividend payer, doesn't have that consistency in terms of the 100% level. So other things here as well to notice, but those are some very standout key points. And we can see here as well, they're covered pretty well in terms of the CPI projection. And then we have to consider Vegas as a whole, whether or not we believe the traffic will affect those properties. But you can see here lots of key events do take place in Vegas. We can see the newly added Sphere. That also brings in a lot of tourists, and at the moment the numbers look very strong. There isn't anything that we have seen that we would say affects the business. We can see their occupancy at 100%. Their numbers overall are moving in the right direction, and we can see their business model for driving shareholder return. We can see here we have the yield, which is very key. In fact, today it's sitting, as we pointed, 6.4%, but it also incorporates the AFFO per share growth. Now, we didn't point this out earlier, but it does sit at 1.7%. It isn't just that, but it's also the external AFFO growth, which, as you have seen from time to time, they do quite a number of acquisitions, and overall that does become the total return. And they've got quite an interesting slide that I thought I would just point out, that in terms of the experience that their real estate provides, it does cover pretty much every single age group, whether that's childhood, retirement, adult years, or adolescence, which helps continue to maintain that occupancy at the right level. And they're also very proud, given they have it as one slide within their overall investor presentation, is that this company has returned, as they say here, 2 times, or in fact nearly 2 times better than RMZ, which tracks a basket of REITs overall. So essentially trying to point out, as we will take a look at, they do typically outperform most REITs. However, if you were just to invest solely into the S&P, you can see you would have underperformed. And a few remaining slides that really point out some of the key things they want investors and potential investors to know. They're included in the top 20 S&P 500 companies by net income margin, where they sit at 70%. Some notable names that they do in fact perform better than: we have Visa, Nvidia, MasterCard, Altria Group, MSCI, Meta, Microsoft, and they say that their business model overall requires minimal overhead and results in outsized margins, which allows them to offer the very nice dividend. And as we can see here, they put themselves as one of the largest US REIT dividend payers, currently projecting $2 billion for 2026. If, for example, you wanted to look at Realty Income in comparison, that sits at the $3 billion level. And finally, they talk about their growth to the dividend, 6.6% year on year. They've gone back to 2018, which is above, notably, the average inflation rate over the last 40 years at 4%. And we can see here their 7-year dividend CAGR, well, 6.6%, the highest against some notable names: ADC, we have ONNN, as well as many other names. Now we can also go a bit deeper to see how they performed against other specialized REITs. You can see the names here, some very popular ones in fact, including Iron Mountain. We have Gaming and Leisure Properties. Now over the last year, this does include reinvesting those dividends. They're actually down 7%, and they're not the only REIT. We have a few others. In fact, IRM down 26%. That tells us this issue isn't solely related to VICI Properties, but actually we can see the wider market overall. And if we do zoom out to the last 5 years, again, they're not one of the best performers. They're up only 42%. If you compare that to Iron Mountain, up 263, LAMR up 107, you can see it has been one of those that has, at least in the shorter term, historically struggled. And we also want to compare their performance to the S&P. Just in the last year, they're down 7%. The S&P is up 13. And if we zoom out to the last 5, well, they've underperformed, up 42, S&P up 85. It is important to remember, though, that past performance is not an indicator of the future. So yes, they could perform the same over the next 5, but actually they could perform a lot better, or perhaps even worse. Now, before we jump into our valuation, we just want to understand 2 things from their financial statement. First one, the income statement. We like the fact their revenue has grown over the last few years. 2015, 18 million. In the most recent annual accounts, they've reported 3.8 billion. Very strong growth, but as always, this doesn't really tell us anything. We want to understand, does the bottom line net income also follow the same pattern? Not always something we see, but yes, for the large part, the answer is that. We can see 43 million reported a few years ago, now sitting at 2.7 billion. The only thing we would say looks to slow down over the last few years. 2.5 2 years ago, most recent one 2.7, and based on a trailing 12 month sitting at 2.8, so maybe we are just getting a little bit of a slowdown for VICI Properties. The next thing is their cash, which as we can see is very inconsistent, sitting at 184 million in 2017, now sitting at 508, so that is quite a large jump, but really this doesn't tell us anything. We want to understand the health of the company, so we compare it to their total debt both numerically and directionally, which has actually continued to increase, now sitting around 18 billion, which is very, very different to their cash position. Massive disparity, which is why we saw the net debt to EBITDA around the 5 mark, and that is why we say something definitely to keep in mind of, and also use it in the MOS today. Now, before we get to the valuation, we want to let you know we have released our latest free weekly article. We drop one every single Monday morning to your inbox, covering severely undervalued stocks, as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to a copy of severely undervalued stocks for the month of December. Lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that you can grab a recently released copy of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. Now, our intrinsic price for VICI Properties gets to just below $37, where we've used 3 models which we can run through. In fact, the first one is the multiples valuation. We have 4 companies which we did take a look at some of these in terms of their comparisons to their past performance against VICI. We have their P to FFO multiple, the average in fact, as well as what is that of VICI today, and this ultimately gives us on the multiples level an undervaluation signal. The intrinsic price here coming to $32, but as always we don't look at one model in pure isolation. We then move on to the DDM, where we have their yearly dividends average growth rate around 6.4. We've gone very conservative moving forwards at below 4%, and that again gives us another undervaluation signal, 2 for 2. Then we end with the DCF model, where their 8-year CAGR sits at 38%. Growth rate we've used is 5%, again more conservative, and baked in today, if you're solely using this model, is 3.2% over the longer term at the $28 mark. So using the DCF, we get a third and final undervaluation signal, which on average comes to 36.74. And as always, you can grab a copy of this model by clicking on the pinned comment below to run through your own numbers, VICI or any others. Now, we also want to understand what is the margin of safety on offer today, and it's coming to 24%. Remember, on the channel, we just want to kick off with 10%, and we actually buy, execute if it meets the criteria of a wide moat, strong financial metrics, good forward-looking data. So maybe you see this 24% and it looks very strong in terms of a buy. Yield is around 6.4%. Wall Street, in fact, double respectable buy rating, seeking alpha as well, comes on average to $35.50. That indicates 27% upside. Now, if you wanted to make a specific note of a 25% MOS, well, a buy at $27.56, and at 30%, a buy just below $26. Now, let us know, VICI Properties, 24% MOS, 6.4% yield, 27% projected upside from Wall Street. In your views, is it a buy, hold, or maybe one to completely avoid? And don't forget, as always, to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon, where we cover our buys and sells. And as always, have a great day. We'll see you all on the next one.